Hi, I'm MJR Invests. In this video, I'm going to show you how to use index funds and compound interest to become a millionaire. Jordan Belfort, also known as the Wolf of Wall Street, made some bold statements in a recent interview that are absolutely true.
And guess what? If you invest $10,000, right, and just compounds at 11% a year, and you put a little extra money in whenever you can each month or each quarter, right, over 30 years, 40 years, it turns into millions of dollars.
And he also offers tips at the other end of the financial spectrum, how to avoid becoming
It
broke.
doesn't work. You can't do that. And if you try to get rich by engaging in short-term trading or picking like one stock, you're probably going to end up in the financial poorhouse.
Throughout this video, I will break down each of his tips, showing you the evidence to support each one. I'll also talk through different scenarios to becoming a millionaire, showing exactly how it works if done correctly.
Exact opposite, which is holding for the long term and all the highest quality stocks and in relying on long-term compounding and reinvesting dividends and making small contributions along the way, but forgetting, like you said, the noise and people are worried about their equities. This is the problem, because as soon as you start buying into that, like, you know what, I think the market might be going down, or maybe it's going to go up next year. You should have to time that by buying and selling. You create taxable events. And also, human beings, by our nature, we're kind of crappy stock pickers. And when you try to pick individual stocks, you tend to lose most of the time.
Okay, so what?
Now this really is the magic of compound interest. An index fund with reinvested dividends will grow absolutely huge over time, leaving behind individual stock picks. Imagine two snowballs side by side, and you roll them both for 30 years. One is left untouched, and the other you take a chunk out of it, i.e. a taxable event, every time you sell and buy a stock. Over 30 years, the untouched snowball that was rolling will be much larger than the other, and this is a representation of snowballing, also known as compound interest. So if you go to this website called the calculator site, you can calculate exactly what Jordan's talking about. So if you put an investment of £10,000 in there at an interest rate of 11% for 40 years, with a small deposit of say £50 a month, you can then see, if you scroll down, that the future investment value after 40 years is around 1.2 million. Now if you go down even further, you can see a breakdown of your deposits and your withdrawals, your interest, the total deposits, the accrued interest, and the balance. And this makes it really important if you click on the monthly one, because you can see at the very start you're only getting interest of around £94 per month, but you can see as you scroll down that interest massively jumps. Here is a visual representation of what exactly is going on, and the orange bars here represent compound interest. Now what you can clearly see at the bottom is the years of investing, and you can see at the very start in years 1, 2, 3, 4 and so forth that the orange bars are really small. Now that can put a lot of people off because you think, oh, the portfolio isn't working for me. But you can see at the very end, after kind of 25 years and onwards, that the orange bars become bigger and bigger and bigger and bigger, even though your deposits are staying the same amount per month. That is the magic of compound interest. Now I know at this point it's really easy to say, oh, 11% sounds a bit unsustainable over 20 or 30 years. But it isn't, because the average yearly return of the S&P 500 is 10.5% over the last 100 years. And more importantly, the dividends that are reinvested account for over 40% of the total gain. Now if we go even more conservative and say you started at an initial investment value of £0 at an interest rate of 9% per year for 40 years and deposited £100 per month, your final value would be about £468,000. More importantly, if we go down to the final year here and look at interest, which is the second column, the $36,550, that's your compound interest for that year. So effectively, by the end of it, you're adding £40,000 per year just from compound interest. This leads on to tip number 2, that individual stock pickers will not beat the market. Of course, there's a few very successful investors, like Warren Buffett, that people compare themselves to, but the average investor will definitely not beat the market.
Is out there, so unless you have inside information, which is illegal, right? And certainly the average person is not going to have that, or some other way to beat the market, whether it's high frequency trading with computers that are lightning fast. So some of the big firms, they'll time the market like a millionth of a second better than an average investor. They get an edge. But for everyone else, you can't beat the market. It doesn't work, especially when you deduct all the fees, the commissions, and also the taxes from short-term trading. So let's say a hedge fund returns 15% 1 year. Say, well, that's pretty good, right? But after they take their 2% management fee, 20% performance bonus, right? Suddenly it's not even beating the S&P 500, and that's on a good year. Most of the time they don't even beat it without their fees.
So why would anyone hand money to a hedge fund?
So Warren Buffett asked this exact question back in 2007, made a big announcement, bet $1 million that I don't care whatever hedge fund you are, you can't beat the S&P 500 over 10 years. And at first, no one took the bet. Eventually, someone did with what's called a fund of funds. There's 100 different funds, right? And after year 7, they threw in the towel. They couldn't even come close to the S&P, and that was without all their fees. And just so you know, the fees they take, so it's 20% typically is their performance bonus, right?
Right.
If the fund makes money,
Off the upside.
on the upside, but if the fund loses money the following year, they don't get any of the losses. So it's heads they win, tails you lose, right?
So this is absolutely true, and here are the stats to support it. And what you can see is that the index fund, the S&P 500, returned 85% over 9 years, but you can see the hedge fund average was only at 22%. So if professional hedge fund managers can't beat the S&P 500, what makes you think that you can beat the S&P 500? The final tip was about how index funds change their holdings so they always remain modern.
S&P 500, which is America's 500 biggest, baddest, most profitable companies. So, and those 500 companies change. So the S&P this year is not the same as it was last year. So what happens when you buy that index as the centerpiece of your investments, right, and just hold it, you're always having the 500 top high-performing companies in your portfolio. Is very tax efficient. Now, it's boring, but it compounds at about 11% a year.
So this one is really important because people always think index funds are made up of big, old, outdated companies. But top performing stocks can break into index funds, whilst underperforming stocks can drop out. This means they always remain modern, and you can actually see which stocks drop in and out online. So this interview from the guy known as the Wolf of Wall Street is really interesting. He's advocating for long-term investing in index funds to outperform individual stock picks. His full interview is really interesting, and I'd recommend watching it. I'll leave a link in the description, but I'm also interested to hear what you think. Let me know in the comments, and please remember to subscribe for more content.